Wall Street's origins are deeply connected to the economics of slavery. This connection extends beyond moral considerations. Slavery influenced the foundational financial structures of Wall Street. The economic systems of slavery were intertwined with early financial practices. Understanding this history is crucial for a comprehensive view of Wall Street's development. In the 18th and 19th centuries, enslaved people were viewed as laborers on plantations. They were also classified as economic assets with significant financial value. This classification allowed them to be used as collateral for loans. Their value was factored into insurance policies as a form of capital. This system reinforced the commodification of human beings. It integrated enslaved individuals into financial instruments of the time. Banks historically used enslaved people as collateral for loans. This practice directly assigned financial value to human lives. Enslaved individuals were treated as assets to secure financial transactions. The loan amounts were determined by the assessed value of the enslaved people. This system perpetuated the dehumanization and commodification of enslaved individuals. Insurance companies provided policies that covered the lives of enslaved individuals. These policies highlight the treatment of enslaved people as commodities. The policies served as a form of financial risk management for slaveholders. Insurers profited from insuring the lives of enslaved individuals. The practice underscores the economic entanglement with slavery. These insurance practices reflect the dehumanization inherent in the system of slavery. Plantations operated as corporate entities focused on commodity production. Enslaved labor was the primary workforce driving plantation operations. Key commodities produced included cotton, sugar, and tobacco. The plantation system's economic model relied on forced labor for profit. Plantations were structured to maximize output of specific cash crops. This corporate model prioritized economic gain over human rights. The economics of slavery were not confined to the southern states. Northern financial institutions played a significant role in supporting slavery. This involvement established slavery as a nationwide economic enterprise. Slavery's financial impact and support spanned across different regions of the United States. Early Wall Street firms were involved in financing slave voyages. These firms directly participated in the infrastructure of the slave trade. This financial involvement supported the transportation of enslaved people. Wall Street's early history is intertwined with the economics of slavery. Wall Street firms played a significant role in the economics of slavery. These firms provided insurance for ships involved in the slave trade. This insurance mitigated financial risks associated with the transportation of enslaved people. Wall Street firms also actively traded in companies that heavily relied on enslaved labor. This trading further integrated financial institutions into the slave economy. These financial activities helped sustain and perpetuate the system of slavery. The New York Stock Exchange, NYSE, has historical ties to slavery. Companies profiting from enslaved labor were listed on the NYSE. This listing indicates a direct connection between the stock market and slavery. The NYSE facilitated investment in businesses that benefited from the exploitation of enslaved people. Northern banks possessed substantial holdings of Southern debt. This debt was intrinsically linked to the institution of slavery. The financial systems of the North and South became deeply interconnected through these debt holdings. This created a complex web of financial dependencies related to slavery. The economic interests of both regions were thus intertwined through the Southern debt held by Northern banks. Profits derived from slavery significantly influenced the development of American finance. These profits were channeled into the core of the American financial system. This influx of capital shaped the growth and expansion of financial institutions. Slavery-generated wealth played a crucial role in the early capitalization of banks. These financial institutions, in turn, facilitated further economic activities. Therefore, slavery had a profound and lasting impact on the structure of American finance. Many contemporary financial institutions have origins that can be traced back to the era of slavery. The economic systems of slavery significantly shaped the early development and growth of these institutions. The financial benefits derived from slavery contributed to the accumulation of capital. This capital was instrumental in establishing and expanding these financial entities. Cotton was a dominant commodity in global trade. Slavery was integral to cotton production. This system significantly influenced financial markets. Cotton's economic power was directly linked to enslaved labor. Cotton was a globally traded commodity. Its price was determined in futures markets. The price of each bale of cotton reflected the value of enslaved labor. Enslaved labor was a significant factor in cotton production costs. This cost was embedded in the final market price. Wall Street's growth was closely linked to the expansion of cotton exports. This expansion highlights the financial sector's dependence on commodities. Cotton production was heavily reliant on slavery. Therefore, Wall Street's prosperity was indirectly tied to slavery. Financial institutions profited from the trade and financing of cotton. This connection reveals the ethical complexities of early American finance. An interconnected system linked plantations, ports, and financial centers. Plantations produced raw materials, often through forced labor. Ports facilitated the transportation of these goods to global markets. Financial centers provided the capital and infrastructure to support this trade. This system generated substantial profits for those involved. Slavery was a deeply embedded and essential component of this economic structure. Wealth accumulated through slavery was often reinvested into other economic activities. This reinvestment helped to institutionalize the benefits derived from slavery. The institutionalization of wealth created lasting impacts across various sectors. These lasting impacts can still be observed in contemporary economic and social structures. The real estate sector's historical practices have roots in wealth generated through slavery. Banking institutions have also been shaped by the economic system of slavery. The insurance industry's origins are intertwined with the financial aspects of slavery. These sectors continue to reflect the long-term impact of slavery on wealth accumulation. Understanding this history is crucial for addressing contemporary economic inequalities. The racial wealth gap is a persistent and significant disparity in asset accumulation between different racial groups. Historical factors have played a crucial role in shaping the current racial wealth gap. The economic legacy of slavery is a key contributor to these disparities. Slavery deprived enslaved people of the ability to accumulate wealth and pass it on to future generations. This historical disadvantage continues to impact the economic well-being of descendants of enslaved people. Slavery operated not only as a moral issue, but also as a business model. This system generated substantial profits across various industries. The exploitation of enslaved individuals fueled economic growth. Industries directly and indirectly benefited from unpaid labor. Slavery's profitability perpetuated its existence as a widespread practice. Wall Street significantly benefited from slavery. Slavery provided substantial economic advantages to Wall Street. These economic gains were derived directly or indirectly from the institution of slavery. Wall Street's prosperity was intertwined with the exploitation of enslaved people. This historical connection highlights the complex and often troubling origins of financial institutions. Examining history offers insights into the formation of present-day systems. Current systems are not spontaneously generated. They evolve from prior decisions and events. Understanding historical context reveals the pathways and influences that shape these systems. This clarity aids in comprehending the rationale and limitations of existing structures. Historical awareness allows for a more informed perspective on contemporary challenges. Recognizing the past enables better strategic planning and adaptation for the future. Current systems are shaped by decisions from past centuries. Historical practices have a lasting impact on modern structures. Long-term effects of past choices are evident in today's systems. Decisions made long ago continue to influence present-day realities. The enduring impact of historical actions shapes contemporary society. Understanding historical context is crucial for analyzing current systems. Finance possesses a long memory, similar to history. Past financial events have a lasting impact. These past events influence current financial structures. Historical financial events also shape present-day inequalities. Understanding financial history is crucial for interpreting the present. Reflecting on economic foundations is crucial for understanding modern financial systems. It provides essential historical context to current economic structures. This reflection is also vital for addressing ongoing economic disparities. Understanding these foundations allows for more informed approaches to economic challenges.